Now, as we turn to the U.S., we always like to look at again, U.S. product supplied, and you can see that we're still staying at about 15.3 million barrels a day of demand. Last week was about 15.4. And when you look at the 2021 level, you can see that there was that little spike that happened as we got into the winter, I should say the fall season. But when you look at the average, again, that's pulling us higher, but still right within that 14.5 when you look at how that's going to progress. And we still see that, again, a lot of this is driven based on weather. You had that weather increase due to Hurricane Ian. That will drop off, that will still stay essentially below where we were in 2021. By no means near where we were in 2020. We think those numbers were too low. It's really something in the middle, and that's where we're starting to see that normalize, and we'll show some of the other things that are driving that, especially people work from home more, some of that less going into the office, and that's something that's going to continue to be a theme when you look at during the week driving versus weekend driving, which is going to continue to see some of that disconnect. Now, when you look at distillate stocks, it drew 3.44 million barrels, and that's now 30.1 million below the 5-year average, with the largest being obviously Pad 1, which is 20.7 million. But things are not getting any better anywhere else, and that's when you look at just where we are and where we're sitting. The problems are only going to get worse as we get people to turn on their heat. In my area, it's been fairly cold. It's going to get warmer for the next 2 days, but then it's going to remain in the 50s. If it reaches, it's the low 60s. But at night, the heat's kicking on. Like, you're starting to get that movement, and we're at a very precarious point as we head into the winter months. Imports were down slightly by 13,000 barrels a day, based on some of the flows. We do see some additional coming into the market. It's just, going to take time to see some of that really show up and make a difference. Now, here you can see Pad 1. It's just bad. I wish I had something insightful to say. I don't. It's just, we're in a problem. And, the White House said that they were looking at, banning the exports of gasoline and diesel. But again, you still need to be able to get the gasoline and diesel to where it's demanded. So right now, exports are from Pad 3. You cannot export from Pad 3 to Pad 1 without using a Jones Act vessel. So if that's expensive, it goes abroad. If you ban exports, there's still no way to get that. Nothing changes. You're just now creating a huge bottleneck at the Gulf of Mexico, and again, you're then increasing demand abroad because we're not exporting, so they're going to buy more elsewhere. And Pad 1, the East Coast, is still left buying. This is not a solution. And again, if you were to allow for a natural movement of using other ships to be more competitive on rates, because the Colonial Pipeline is tapped out, it's fully spoken for, they're moving as much as they can because pricing obviously dictates it, but that is not going to change anytime soon. And putting a ban on exports is going to do nothing outside of increase international demand, which is going to take away or increase the cost for the East Coast to purchase product. Again, a terrible decision. Or even a thought exercise that, I'm happy to nip in the bud as soon as possible. Pad 3, again, seeing where it is, fairly normal, right in line with 2021 levels. It's obviously below the highs of 2020. There's been 3 or 4 years higher, but still fairly normal in Pad 3. The question is, how do you get it from the Gulf of Mexico to Pad 1? Again, Jones Act. Just waive it, delay it for a year. I don't the options are endless. It's something where the stroke of a pen, you can get rid of it, not so much get rid of it, but just pause it and say, look, because of these issues going into winter, we need to waive this for a year, 12 months, 8 months, anything would be better than what is currently happening. And that is some of the issues that we continue to see. So when you look at product, the demand, it's just coming down, just above where we were in the 5 years because of that dip. It's elevated, but we see that distillate right now is going to be, just below the 5-year average as we go forward. But then we see that again moving higher as we go into the winter months. A cold winter, and it just gets ugly very quickly. Some of the benefits, though, will be that slowdown in shipping demand. We continue to see it. That hasn't stopped. We see that grind down. Again, it's not going to be this huge crash, but you're seeing the steady movement lower with the way the shift is and the way some of this data continues to show where demand just isn't there for trucking as it was. It's still at 2018 highs. It's not that it's collapsed. We're still have demand. It's just not what it was in 2021, at the end of 2020. It's something that is going to continue to drift into more of the normal category, especially as you have shipments coming into China, into the West Coast at a slower and slower clip. That is going to continue to be one of those key drivers. And then here you can have, there's some heat that remains as you look across the Midwest and into the West Coast. But you're starting to see, again, that cold remaining, either near normal, at normal. You have a little bit of above normal. So you'll have kind of that mixture of where are you seeing the most demand for natural gas, heating oil. And that's when you start looking out that the cold is starting to set in a bit, and that's going to, again, increase the demand for natural gas. Again, along seasonal norms. I'm not saying that there's going to be this huge snow bomb in the next week. So it's just, again, very seasonally normal as we start to get through areas that would normally start seeing their heat click on. When you look at gasoline had a nice draw of 4.73 million, and all of that was driven by Pad 3, which had a drop of 3.78 million. A lot of that was into the export market, into movements into other areas to make sure that there was enough, especially as Hurricane Ian approached. Imports were down 44,000 barrels a day, 347,000 below the 5-year. As we showed before, imports from Europe still remain low. We do see some of that changing, but again, rates still remain a bit expensive, so we don't see that changing too fast or too quickly. Blending components had a draw of 3.34 million. So again, remember that disconnect between gasoline storage, blending components just means that we'll have a bit of an outsized increase in gasoline storage next week. So it's still going to be hanging around that 29-year average, a little bit above, but you're still seeing some of those movements. When you put that in perspective, you get an idea of we normally see that drop. It's just a matter of when do we see it. And then as that things still remain a bit sluggish, that's going to put things back into storage, which will move us closer to normal, if you will, which is probably, let's call it another 3 million higher. And that will move us closer to really where kind of we should be at this point in time. It's just going to be a matter of how quickly does that happen. When you look at China, Chinese congestion index remains elevated. It's moved back up. Google Mobility Index, when you look at things for Americas and Europe, again, flatlining below that normal level, which we see to be consistent, while everything in Asia Pacific still remains fairly strong, which is keeping that world total elevated. When you look at the TomTom congestion, Europe still remains high, so we should see a little bit of that drift higher in the Google Mobility side, as well as the Asia Pacific still staying strong, while the Americas is starting to weaken. And a lot of that is driven more by weather. So it's not that we're going to see this big drop. It's just some of that was weather related that will normalize, but again, normalizing at a reduced rate. China is the odd one out. This is a holiday week, so there is some of that to consider. It's still going to be well below expectations, especially given COVID lockdowns. They were trying to keep people from traveling too much for fear of spreading, obviously, COVID any further. But it's so there should be a bump. The question is going to be how long does it last and how does it compare to the quote unquote normal periods. So then when you look at pricing still remains elevated. We've seen an increase in gasoline prices from that low of about $3.60 back to about $3.80. Now we're going to have support in gasoline prices at these levels. It'll drift higher. Does it get back to $4? I'm going to say no. Could it get to $3.90, $3.95? Absolutely. It's just going to be a matter of how some of that pass through comes in. It will also, where diesel prices are currently at $4.86, obviously national average. We see that getting much closer to $5 as we progress through October and enter into the winter months. And then back to the blending components, here you can see we're just below that 10-year average, but we expect to see a bit of a bounce, and that's going to again put more product in on the gasoline side. Here's when you look at the last 10 years. So we had a 10-year low, and now we have a 10-year high. So I'm just going to give you a quick tutorial on this. You always take the 4-week rolling average, which is why we talk so much about it. There's a lot of noise in this data. We've been saying it's been trending a little too low. Now it's way too high, and it's just going to come back to about that 8.6, 8.7 level. The hurricane had a big impact because you had a lot of people pulling forward, getting gas before they traveled, escaped from the hurricane's path, or they knew they were going to get hit on as it passed through the remainder of the Carolinas, the Mid-Atlantic, the tri-state area. And people wanted to make sure that they had enough gasoline in case there were hiccups in the supply chain, which pulled some of this forward. So we do see that drop off coming as we progress through the remainder of this week and into next. And then when you look at activity, again, workplace, people are not going to the workplace the same way. We're still 20% below normal. That is the driver of where we're seeing demand for driving not exist in the same way. It's Monday to Friday. If you go out on the weekends, I guarantee you are seeing a normal, if not more than normal, activity. It's during the week you are seeing that drop off, and that's when people are like, well, when I go to the restaurant, everything is fine. It's like, well, are you going on Saturday or are you going on Tuesday? Because if you're going on Saturday, 100% agree with you. If you are going on Tuesday, the things are different, and that just is what it is. I hit more traffic on the Belt Parkway on Sunday at 12:30 p.m. than I did on Tuesday at 5:30 p.m. And again, it's like a random 12:30 p.m. drive home. During some inclement weather. I'm coming the opposite way from Jersey. But yet 5:30 p.m., which should be peak rush hour in New York terms, and I'm cruising. So again, that's where we're seeing. And I know that is a myopic view of my own personal piece, but I'm just using that as an example to show the national average, because I know people like to use their personal experience to say, well, because it happened to me, it's happening everywhere. I'm just saying that this is what the data is showing. It's not so much that the weekends are different, it's that the weekdays are different, and that's where you're seeing that drop in underlying gasoline demand. So now when you look at propylene, there was a build of 1.56 million. We're essentially close to where we are on the 5-year average. A lot of this quick buildup is being driven by the drop in petrochemical demand as the petchem side has cut run rates, and that's something that we see again maintaining and staying fairly reduced as we head through the remainder of the year, really. Jet stocks dropped 540,000 barrels. That's that's now 7.1 million below the 5-year average. Here you can see again we're right back in line with where we were expecting, between that 1.45, 1.55 million barrels a day of jet fuel demand. And just based on the TSA passengers that you're seeing here, that's where we expect. Like, just again filling in the difference between 2019 and 2021, we're just going to sit right in the middle of that number, just because there's the economy isn't great, and people are not traveling the same way. And that's really, again, that impetus for being below those 2019 levels. And we're continuing to see that play out with passenger flight schedules for the next 12 weeks ahead is 0.63% higher than it was the last week. Nice little positive, but again, that balancing act between because if you think about, the next 12 weeks, you're coming into Christmas, and that's where you normally see, Thanksgiving and Christmas, which is normally when you see those increase in flights. So again, something very seasonally normal. The number of passenger flights over the week from September 27th dropped by 1.21% week on week. So we're seeing a drop now more than normal. But then we're seeing an increase in flights along seasonal norms. But because we're starting from a lower level, those increases again are just going to be underwhelming in comparison to where they normally were in 2019. And then open table data, again, showing that things are fairly elevated, or I should say in the U.S., fairly normal versus historics as things remain elevated. And again, a lot of that is just driven based on timing of lockdowns, where the U.S. has really the most normal kind of backdrop. And that's where we're either right at normal, just below, and things remain fairly stable. So that's what we have for you in segment 2. In segment 3, we're going to go deeper into the physical market, some of the shifts there, and how the OPEC data and OPEC information can change things going forward.